no intro is going to do Cody justice. I mean, we have not just a speaker today, we got an encyclopedia of small bay knowledge. And for you young guys, an encyclopedia is pretty big body of knowledge. So you can just ask Cody later because he'll know what that is. He's from Flex Parts USA. You can see his logos everywhere. They do brokerage, site analysis, leasing, feasibility studies. He's an author of Flex Space Domination, which you can get on Amazon. I get a cut for that, Cody. He's a speaker at just about every small bay conference, and he does that for a free ticket. He's never turned down a microphone, and he is no stranger to a microphone.
They come with free lunches too, so you didn't mention that.
And he was also the most influential person in small bay in 2025. I don't know who made that up, but it sounds like one of those trophies you can buy at the local store. But
it does. They sell them at Costco.
Cody's an all-around great guy and always willing to answer questions and help on a deal. I've got him on speed dial, and I call him anytime I have a question. My friend, Mr. Cody Payne.
Well, I appreciate that, and I really hate that you built me up so high because we're going to disappoint here for the next 10 to 15, 20 minutes, but that's okay. We always get better, but yeah, real quick. So Cody Payne, Flex Parts USA. We do a few things here. We do site analysis work, so we can analyze a site if you're a new developer, or even if you're buying an existing building. Which Will kind of uses us for both on those. We can take a site, we can look at it, check out the business metrics, demographics, just kind of make sure everything's lining up and that it's in the right position, or if maybe things need to be looked at a little more thoroughly. We also have our market feasibility arm that really does a deep dive to really figure out, hey, what's the best way to make this park run, and is this a good area to do it, right? What amenities do we need to add? What size units do we need to do? What does the competition look like? How do we elevate ourselves from the competition? And so we do that. And then on the other side, which is what I mostly run here with Austin, is the brokerage side. So we specialize in selling small bay industrial across the U.S. We actually got one of our latest guys, Matt Funk, I see on here, runs our Florida office now. So good to see him. But we sell all across the U.S. And this is the 20th year that I've been in business. And I will tell you, it's still very, very exciting for me to wake up and do this. And I think I was joking with Thaddeus or Will a while back ago is, now that there's so many eyes getting into this and this asset class is really growing and expanding, because when I first got in it, I was a leasing agent, and the tenant base was very minimal, right? It was very one directional, just contractor, and that's it. And now it's just so diverse that, and so it's really good to see all these cool events, seminars, and this base camp deal that Will's created to have all these people. Because I mean, if this was 7 years ago, it'd be me and Thaddeus and Will at an IHOP. Like, that'd be the biggest flex event of the year. And so it's always really good and exciting. I've got a few slides I'll go over, and really just to show you kind of some of the ways that we look at sites, what we like to see. Now, everything kind of, I always say, take these with a grain of salt, especially on a national stat level or something of that nature, because certain things maybe look bad from a very high level, but can be much better going in. And I'll give you a prime example. So Will and I were actually looking at a site, and we did a world engine analysis for him on it, and he said, "Man, this looks really, really bad." And I said, "It does, because there's zero new product. It's all old product. It's all, I don't want to call it obsolete, but it's very one-directional product." So when you've got an area that's all older stuff, low ceiling height, they don't have that ability to get certain tenants. So they don't have that ability to get certain rental rates. And so sometimes it's figuring out, okay, we don't have any new product. So what do we look into? We want to look into maybe some of the demographics, what people are able to pay, how many 1 to 5 employee businesses are out there that would maybe be small bay businesses, what those guys can pay. And so really just kind of understanding those metrics is where it's going to be. It's a really good Friday today too. So very excited. So also going over saturation, can everybody tell me, can y'all see this? Anybody?
Yep, looks good.
Y'all see my window loud and clear? All right, perfect. Thank you. So I've got a national snapshot. We always do this. If anybody ever needs any of these or anything for a more direct market to kind of see what the national numbers look like, we can do that, or state or major, have a lot of those on hand. One thing that I always point to, and I'll just be kind of quick on this vacancy rate. Vacancy rate in Flex always sits a little high because of so much new construction that is proposed or under construction. It's all vacant. So it's built to spec. It's not generally pre-leased. And so that skews that number a little bit. You will see some markets that are at 10, some at 11, 12, but there's usually a buffer that we can pull off of that. It's actually closer to 5 on the national level, but because of all the new construction, it's going to skew that a little bit. One thing I want to talk about, this is a question that we get a lot, and Will wanted me to kind of talk on this, is understanding a market, and especially for new construction, if you're going into it, what are some signs of a oversaturated market? How can you kind of tell where the market is, where it's headed? Am I getting in too late? Do I need to reevaluate what I'm building to be different? How do we do it? So some quick early signs, right? And if it's a saturated market, these signs are going to be easy to find. That's the best thing about a saturated market, is these things are usually easy to find. So is the vacancy rising faster than the rental rate, right? Is the vacancy, on-time market vacancies for spaces sitting longer over a period of time? So if 3 years ago, a vacant unit was sitting for 2 months and today it's at 4 or 5, that's a sign, right? That's a very quick sign. If the rental rate is not increasing like it has been over years, or is flat, that's another sign. We've actually seen it go backwards in some markets. So those are 2 really key indicators that are very easy to find. And then it doesn't say not to go into that market, because we go into saturated markets all the time. We just don't advise building what that market has. And I've got a few examples in here I'll give you, but a lot of those markets that are saturated, they're going to have a lot of lookalike projects, right? We always tell people over 80% of the new construction is your basic efficient build, right? That's the easiest build. That's the build that, a lot of people from storage, multifamily come over and build. It's the cheapest to do. It's the easiest. They can get it off the ground and going, but it's the most replicatable. And so anytime in life, and that's just any asset class, anytime you have something that's just highly replicatable, I don't even know if that's a word, but you understand what I'm saying. That is a recipe for oversaturation. A few other things to look into that you can't always find on the surface level, it sometimes take a little bit more digging, is the concessions, right? Are those concessions returning to some of these markets, right? Is there a lot of free rent being given? Is there higher TIs? Are there lower annual rent bumps? Are the terms highly flexible? And I'll give you a prime example. We had a guy looking at a site, and Austin really knew the area really, really well, and was like, look, man, everybody out there is offering rent specials. It's very rare to see rent specials in Small Bay. And so when you see ads online, 2 months free with a whatever lease, because I think one of this was like literally 3 months free on a 2-year lease, like for a very basic build, that's something that should not be done. But because there's so much built out there, that's why they have to do that. And so understanding the saturation in the market is going to be really, really key. And like I said, those are the key factors to look at. And if you ever need help with it, you can give us a shout and we can help you take a look. But we want to mitigate those early warning signs. And it's going to be those 2 to really kind of stress test it. Can the market handle more Small Bay, right? There's going to be a lot of little things we want to look at. We want to look at population. We want to look at job growth. We want to look at the trades in the area, right? That I was talking about earlier, the 1 to 5 employee business count. Those are going to be some of your highest Small Bay potential tenants, right? When you start going, over that number, you start reaching 10 plus employees, you're getting out of the Small Bay sector. Understanding all the tenant profiles, right, that can be there. A lot of that's going to be combined with the spending per capita, the home values, the incomes, things of that nature, right? Because If you have a lot of lower incomes in older areas, you're not going to have as many higher end sports related tenants, right? You're not going to have as many higher end fitness studios and gyms and things of that nature that really pay those good quality rates. And so understanding how those can impact are also key. Let's see, existing inventory versus competing pipeline. We always want to look at that. We always want to look at who's building what, where. If it's in the county, that's going to be one of the harder things to find new construction wise. And one thing I can tell you is this is very similar to self-storage, right? If somebody's building a small bay industrial park and it looks like it's having success, I bet you a little bit of money, somebody's going to be building something very similar if they can. And so that's why I always say build something that's a little more unique. And there's a lot of different things that you can do to these parks, whether you're doing metal, block construction, tilt wall construction. There's a lot of little things that you can do to make these things look good. And one thing we're always doing, if nobody's watching them, and I'm not trying to get you to watch my stuff, but we've been doing a lot of property tours of unique industrial parks. I'd advise you take a look at that. And then we also have a lot of cool renderings in other parks that we've sold, and really good to just go through there and get some good ideas. But understanding how much demand is needed to absorb the new product, right? How many of those 1 to 5 employees are there versus how much square footage is there. I mean, there's a lot of little things that we can look into to figure that out. But then one of the bigger things, and I really want to impress this on you because this is something that we deal with a lot, is because there is competing product in a lot of these areas, it's really finding out what do they all have in common and what are some of the outliers. And I'll show you one of those here in a second. But if the area is all 2,000 square foot units at 16 or 18 feet high, not really offering any amenities, then maybe you want to look into doing something that's, 1,250, 1,500 square feet, that's maybe a different increment size, because you're going to have in a lot of these parks, you're going to have a lot of times 35% of the tenants taking more than one space. So having a good friendly increment, people don't realize that's something that actually hurts a lot of new construction builds and a lot of older builds as well. What pencils well versus what looks good on paper. I have a new prescription coming in, so I got to look a little closer here. Land basis matching achievable rents. This is one thing that I was actually talking to Thaddeus a while back ago, because a lot of people that are doing new construction or looking to build a park, they'll say it's really hard for me to make something pencil unless I'm getting X dollar in rents, right? And so that's something that anytime you're looking at land, what I always tell people is you don't want to find a piece of land and then kind of figure it out and start adjusting to make things work and cutting corners here, making the model look worse. You want to really have a model in mind that you want to do. And then it's easier to be like, okay, here's this model. Here's kind of a preliminary cost of what it is. Obviously, you won't have dirt costs and things of that nature. And with this model, I can probably get this rental rate. And then now I need to go out and find sites that have that rental rate, right? And so whether you're using Land Vision or something of that nature, going out, finding sites that are 3 to 5, 7, 8, 10 acres that are in areas that you can get that 14, 15, 16, 17, $18 foot rent. That's kind of the way to do it. It's kind of a little reverse way of I like doing it, but you want your rent assumptions to come from real comps if you can, not just the best deal in town. I always tell people if it only works with the highest rents and everything having to work perfectly, it's probably not going to work. And so really just understanding all of these things, lease up timing, concessions, contingencies, all those things, right? You need to make sure those are penciling well. Cheap land in the wrong location, we see that all the time. That's probably one of the top 3 mistakes we see made in new construction, right? Is people just getting really good cheap land and it's just too far off the beaten path. And then also not understanding the area and what the area offers. And so you want to understand how to get to stabilization, what's a good timeline to get there, what your absorption looks like, what your cost is going to be to get there. Underwrite the site before you type the land. What do we want to do? We want to define the product. That's what I was just saying. We want to understand what we're building. before you're building, you want to understand the rent, the sale, the vacancy, the competing pipeline, not just the broker quote, but what is actually going on out there. Then you want to draft a site plan. We always tell people to do that once you're kind of looking. I'm a big fan of pre-marketing, right? Not keeping an ad out there for a long time, but if you're a little uncertain, it doesn't hurt to maybe go ahead and do some Facebook. And I think the young lady was on the other week actually talking about the Facebook and Google ads. We do a lot of those here for leasing space. And so sometimes doing a little bit of pre-marketing just to kind of test the market, I don't think hurts anything. And if you're going to do that, it's always good to do a couple different unit sizes. And so maybe you'll see one collecting a little bit more traction than the other. Understanding land basis, hard cost, soft cost, contingency, financing, everything within there, everything to get to the occupancy, stabilized NOI. And then, like I said, kind of stress tester from there. And if anybody ever needs, we have a really good, and actually I'll put this out on the school network. We've got a really good financial model that's a really friendly one that I'll actually put on there. That's kind of a good waterfall model for anybody that is doing a little bit of fundraising and for new development and whatnot. I know these things can be pretty intense. I did an example here, and there's no financing in this example. And this is just something that I just wanted to show. And I've got a really good one that does have several financing options in there that kind of show what these look like. And so on the surface, this looks really, really good, right? But this is an all cash deal. So if you buy 5 acres at $4 a foot, your 30% lot coverage, build cost is $100. If you're getting $12, your yield on cost is 10.5. If you're getting 14, it's 12.35. Those numbers drop quite a bit once you apply financing in there. And so basically the reason I wanted this to be in here is to just kind of show you, like, you want to kind of have this subset, this kind of model ready to go and easy to use for scenarios like this, especially if you are raising money, if you're paying prefs, if you're going to a family office or whatnot. Understanding how to get to those numbers quickly and what that cost is to get there is going to be pretty key. I think I'm still doing okay on time. I'm trying to blow through here. Okay, what do we like for a small bay industrial site? We love high growth submarkets, right? We love being near major metros, but just a little bit outside. If you can find a good master plan community, which is really, really key, because these things bring in a lot of infrastructure, a lot of new homes. Sometimes you're building schools, adding retail. You're going to be able to get in significantly cheaper now than when the project's built, obviously. And so you may be a little bit ahead of the curve, but I never have an issue with that. So finding master plan communities or places where they're building a substantial amount of good quality homes. Obviously, infrastructure and access is very, very key. Business density, right? Understanding the business count, that tradesmen, that small bay business count, how that number is increasing. Do we have a good increase? Is that showing us a good increase in the market? We want to make sure that that's there, and then land basis that still works, right? And understanding that, because even though when we're looking at a site, we're evaluating it on today, in many cases, that site is going to be looking significantly better when it's up and running. So I want to give you an example of a park that Austin and I actually sold not long ago. This is in an area that has a lot of vacancy, right? It's got a lot of new product, a lot of the same product, a lot of stale rental rates over time, increasing time on market for vacancies. And this owner we've actually worked with in the past, he had this piece of land and he's like, man, I want to do something with it. I want to build small bay. And so we said, all right, look, we need to get nitty gritty on this thing and really figure out what to build here. So everybody in the area was closer to 2,000 square feet on their units. I think they're about like 1,850 or something was the average. So we said, look, let's do 1,250 square feet. So we offer a smaller unit size, but our increments are much friendlier and better. And so it gives us ability to lease more units to a single tenant. And so if you were 1,850 square feet, I mean, you really only had 2, maybe 3 options max on, removing that demising wall and bringing a tenant in there before you're kind of out of the small bay tenant mix. This one, we did it so you could lease 1250, 2500, 3750, 5000. Like, it's a very friendly tenant mix. And then we added 1,000 square feet of rear yard space, which you can see on this bottom photo here. And in doing that, they leased 35 units, 4.5 months. Their rental rate was about $3 higher than the competition, and we ended up selling that deal pretty quickly. And so Ron Rohde said he loves that rear yard. Ron Rohde's the yard man. And so that was it. Open it up to any questions or anything that anybody has. Get this Friday going.
There's a lot of information. Anyone have a question?
Yeah, on
that was some good information.
Your opening slide, you had an average sale price. I think it was $184. What is that? Is that for the project or for?
That's for the entire, so that's for the entire small bay industrial park. That's an average sales price of the entire US.
All right. Because, you know, we've worked with a guy that condoed, and I think he sold a 1,000 square foot unit for, this is a far south, for I want to say 145,000. So that's why I was going to make sure that we were looking at the same metric.
Yeah, no, that's just an average of all of it. And I will tell you, condo sales, especially if you're talking car condos or luxury condos, those are kind of a little bit of an anomaly in my opinion. Because I mean, you've got X down there in Austin. I mean, at one point they were selling units for almost $1,000 a foot. So, but that's not a true small bay investment like what we deal in here. But I mean, condos, there's a lot of money to be made in condos. I will tell you. If anybody doesn't know this, condo sales are at their lowest right now that they've been at in a long time, especially any type of tradesman or contractor style condo, because anytime you have an economy that just has a little bit of hesitation, it's just 10 times easier for those businesses to go sign a lease and be in next week than to spend 2 months trying to buy a condo. And so that's what you run into on the condo side, is a lot more market volatility.
Hey, Cody, this is Brett. I had a question. Can you hear me?
Yeah, Brett, go on.
Hey, so
good to hear you.
the strategy, the pre-marketing, going out, trying to find what the market will bear for the product, whether it's efficient, hybrid, or whatever. I'm up in the Northeast where I am, and you and I have talked a couple of times. They don't have much of this. Not a lot going on. So like the brokers and so forth in the area don't really have good comps, don't have good data. How successful have you or anyone else on this call, or anyone that's talked to other people that have done this, how successful have you been or seen with this kind of testing the market? Whether it's put a couple renderings together, put a Facebook marketplace ad, a Google ad, something that says, coming soon, or coming 2027, and it gives a little bit of information, maybe a general area. Maybe you don't even have a site yet, right? But you're thinking this is where you'd like to do it in a 2-3 county area. Have you seen success in being able to really dial in what the market will bear in terms of rents that then will help validate the underwriting that you're doing? Because like where I am, there's just not, product just doesn't exist, so you can't go around and find much info on, okay, is it 12, is it 14, can you get 15 a foot, is it 10? What have you seen with respect to testing the market with those ads, or anyone else, to validate rental rates?
Yeah, and I'll let anyone else chime in as well. We have done it several times, worked with a lot of owners doing it as well. We have seen it really help out quite a bit. And especially engaging activity and interest in what size units. And so I highly recommend doing it. I don't recommend keeping an ad out for months on end, obviously, but I think doing a Facebook or even Google ad for a few weeks, I think is a very good thing to test a market. And we've had a lot of success doing it. And so we've actually got a guy building south of here. They did some Google ads, and it proved to have a lot of inquiries. And so they ended up buying the land and building the park, and one of our guys is already leasing it up, really based off of that.
Yeah. Okay. Yeah, great. Maybe you and I can connect after the call, or next week, and if you have a few examples. I've seen a few examples of these ads, but if you've got a couple you can share, that'd be great.
Yeah, I'll dodge your call, but yeah, I'll talk to you.
Brett, Brett, it's a permanent line item on my due diligence. I mean, I've done it with every
Yes.
asset class I've been in. I do it on
Okay.
every deal, whether it's a value add or if I'm looking at a site. I run 3 ads, one a week at a time, and it's hard to gauge actual rent because they haven't seen the space, right? And so, but
Right,
you can gauge
right.
inquiries, you can gauge, interest and things like that. So it's I wouldn't take it as a hard fast comp, but you can certainly gauge market's interest in your product.
Yeah, I think I think that's a good step. There's a site I just finished up a feasibility study on, with a partner that we're looking at. It's about 5 acres, good area. Cody, I think you and I might have talked about it a few months ago, but we're kind of to the next step where is there a deal or not a deal? And some of the big variables are what the market would bear. I mean, I've got quotes in from construction, and I wish I was at 100 a foot, Cody, but I'm not. So that's kind of putting some pressure on some of the other things. But I think that ad strategy is something I probably need to push on here in the next month.
Great question, Brett.
Yeah,
Anyone else
I
have a
would.
question for?
Yeah, I'd look into do that.
Thank you, guys.
Hey, Will, I've got a question.
Yes, sir.
Hey, Chris Fulmer. Will, I'm actually in your hometown here. And in talking about lack of comps, I feel like there's also a lack of good information on cap rates and exit caps, particularly in non-core. I know you've got quite a few in Texas, Cody, and perhaps big bellwether markets southeast. But what are you seeing, I guess, maybe in not only in first tier, but second tier markets? And what do you, maybe as best you can, see that looking like over some reasonable period of time here?
Yeah, and so there's going to be a few things that are going to come into understanding what your cap rate is going to be on your exit, right? It's going to be quality, location, and where the property is and where it's performing at, right? Is there still a lot of value add? Is it fully stabilized? Are we, 95+% leased, fully stabilized? Is it basic metal? Those are going to run closer to the 7.5 range, depending on the area. If you're too far out, right, you're going to start seeing those things creep up to 8%. Now I'm just giving you a general number, right? These things move around all the time. We did a park not long ago. It was a 4.75, and it was really basic build, but the rents were so low that it had so much value add that, they had the ability to get that thing quite high. So the higher the quality, the better the location. And if they're triple net, those things are all going to come into factor on that valuation. But to just give you a range, I'd say 7 to 8.
And never listen to your broker exclusively. I think your banker, because they see tons of appraisals across different asset classes, they tend to see the cap rates change before anyone else. That's just my take on that. No offense, broker, but you guys tend to tell the story to sell the deal, right?
Yeah, well, I got to sell the fajitas over here, man. Nobody's going to sell these things.
Good stuff.
Yeah. I probably have time for one more if anyone else has another question.
I got one real quick. I see there's a few in the chat. I'm sorry, go ahead.
Oh, I didn't see the chat. Okay. Go ahead.
So a question from David, for the trade area, 1 to 5 owner employee companies, what radius do you recommend? Let's do 5 miles on that. If you are too rural, you can stretch that to 10. Zach Walega. Sounds like a Street Fighter name. I like that. Would
Thank
test.
I was just
Yeah.
responding to Brett. I was just responding to Brett, but
Okay.
appreciate that. I wish I was a Street Fighter, but
Yeah.
I'm not.
Hey, Cody, expand on David's
so-
question there. You and I talked about one the other day on this. So you talked about the multiple between like a 3 mile and a 5 mile on the businesses. Expand on that a little bit.
As you get more rural, as you go farther out, those people drive farther. So you can expand that radius more. As you get closer to where it's just a lot more dense and just more homes, that's when that radius really starts to shrink a little bit. And so you see that really in any market across the U.S. is the farther out you are, the farther those guys are willing and need to drive to service the area.
That was a different David than me, but what I use is a 10-minute drive time. because that seems to me, and if you're at like an interstate highway, 10 minutes on an interstate gets you pretty far. So to me, that's a better measure, but it's good to look at all of it.
Out here, it gets you about 20 feet. So you ain't gonna get too far on a highway out here in 10 minutes, but and depending on the market, but I agree with what you're saying. In a lot of areas that if you're counting ETJ, that 10-minute drive is substantially different than any infill area.
So I know you covered a ton,
So-
but talk about the 3 or 4 main metrics you look at on the world engine to determine a site.
So a few things that I really like to see, I like to see that spending per capita over 10.5, right? That tells us that there's good money being spent in that area, right? Those people have money and it is being spent on things. I like to look at the rental rate and how that has changed over time. And then I like to see the on-market vacancy timeline and how that looks, right? Those are some really key things that are going to tell you, hey, look a little closer or be a little more cautious, or maybe it's just, a no-go. You'll see a lot of areas that will have basically no population increasing or sometimes negative. That doesn't really scare me as much. As long as that business count's high, right? If that business count, if you're in a good deep infill area, or even in the county or something, and that business count is increasing threefold over a 2 and 5 mile period, that's a good thing, right? So understanding that, also understanding how that business count is growing as well over the years are going to be some key things to look into. But like I said, the first thing that catches my eyes is vacancy, how that looks now, how it's looked over the years, rental rate, and that spending number. Those things are going to really help me look into this thing a little bit further. But we look at everything, but those are like, if you need 3, that's 3.
I remember a point that Thaddeus made a few sessions ago that I thought was really good. If the vacancy rate is extraordinarily low, that may mean the rents need to be higher.
Yeah.
100%.
Yeah, that was the multifamily rule of thumb for the longest time. If if you're fully leased, your rents are too low, or if there's no vacancy, your rents are too low. Also, the biggest thing in small bay is vacancy reporting. It's very scattered, and you'll have people. I mean, we're selling a project right now. I mean, he's fully leased, but his vacancies are still showing on the market, and it's been showing on the market for a year. And so that's one thing that a lot of people will run into, because there's not really a big. I know Industrial IQ's navigating to really kind of be the front handle of this stuff on the small bay side, but that's the biggest hurdle that we have, is really understanding the true vacancy and how long these units are actually sitting. And so that's why our SBF guys, I mean, they got to pick up the phone and actually call and figure it out. But like I said, I talk to Will about that all the time. That's the best thing about small bay, and that's where everybody here has the advantage. And even me and myself, don't have that data infrastructure. This asset class doesn't have that. It's a lot of fragmented owners. It's very difficult to find stuff. It's mixed with big box industrial. It's mixed with storage. And so that's what makes this so appealing, because that data is hard to find. That's why a lot of people struggle with it. But when you start narrowing down the area and you start, honing in and calling the competitors and things of that nature, you get it figured out pretty quick. All right.
Great call. You knocked it out of the park. You nailed it, man.
Dude, I was
Great
so
job.
nervous, man. I threw up like twice before I got up here.
Hey, kudos, Cody and Will. 35 people at the peak of the call today, 34 at the very end of the call. Kind of speaks a little bit to what Will's built here and to Cody's incredible draw in the industry. Appreciate you guys very much for doing this.
Well, my mom was on as well, so that helped out. and a few of her friends.
I love it.
So,
Yeah,
I appreciate y'all. I appreciate it. And I appreciate y'all. And, y'all got our contact here, Flex Parks USA. If you ever need anything, man, we always love giving a hand and helping out and trying to put you on the best track to move forward and have a good time.
I call Cody every Friday afternoon and bug him with questions, so feel free.
That's all right. I have any
Good
time
job,
minutes.
guys. Good job. Thank you.
Thank you,
All
Brett.
right. Thanks, guys.
I'll see y'all.
Thanks,
See you
Cody.
everybody next week.